You're saying that China provides a good combination of yield or income, size of market for deployment, and portfolio diversification. Could you explain that a bit more?
Sure. Overall, starting with the view, we are positive on the China onshore markets. We have seen a backup in yields there, but at the current levels, we actually are quite positive. You've seen obviously the data, the credit data yesterday was pretty strong, better than market expectations. The inflation is touch on the weaker side as we saw this morning, and the liquidity injection from the central bank is very much there. So when we look at in terms of the nominal yields, the real yields, the potential direction of monetary policy in China, we still see China bond market to be fairly attractive. And it's a market with very low correlation, in fact, close to zero correlation to the global markets, driven by very low foreign participation at this point, which is slightly over 2% in terms of foreign ownership. So you have high nominal yield potential to generate returns in an environment where rates are pretty low globally, and a portfolio diversification through the correlation aspect.
Yeah, but what about liquidity concerns in the credit markets in China? And a case in point that we discussed in the past as well, Evergrande struggling with its issues on the cash side. And even in the private placement that they did yesterday, they were looking to raise $1 billion. They actually managed to raise only half of that amount, whereas their credit due is about $6 billion coming to the fore in the next 2 months. And so how do you play that theme, and how do you avoid the risky bets in that domain?
So you have to, first of all, leaving aside the idiosyncratic risk, you have to think about portfolio construction with diversification and resilience. I think that's the underlying thesis for any investor today in this environment. And when you think about, again, the China onshore markets, it's a fairly large market, close to $16 trillion. And you're looking at a market with the government bonds, policy banks, local governments, SOEs, the local government funding vehicles, and the private corporates. When you look across that whole spectrum, you can build a fairly diversified portfolio with pretty reasonable income, and at the same time, not really taking a lot of idiosyncratic risk that you're talking about. So I wouldn't be worried about that, given the size and the diversification element that you can create.